What's going on? My name is Amy Nicholas. Welcome back to the channel. In today's video, we are taking a look at this amazing book, Market Wizards by Jack Schwager. He did this book back in the 80s and he updated it for 2012 to add a little bit of commentary at the end of it. But basically, he interviewed like top traders, people from the pit trading, Chicago, New York, people that have been successful, 70s, 80s, 90s. But yeah, a lot of these interviews, to my knowledge, I'm looking at the publication date, which it doesn't exactly say it in here, but you can tell when he starts asking about the years that people are trading, that some of it is like, yeah, these are pretty older interviews, but the knowledge that you gain from these top traders is like invaluable. So a lot of them are day traders or some of them are swing traders. There was a couple people he interviewed that were more like investment kind of people that hold these things for a lot longer. Just to give you a quick synopsis of like, maybe you'll recognize a name or two in here. When I first scanned the list, I think I only knew like one or two people. But there's Michael Marcus, Bruce Kovner, Richard Dennis, Paul Tudor Jones, Gary Byfelt, Ed Sakota, big name, Larry Height, Michael Steinhardt, William O'Neill. Now he's the investment guy. He wrote How to Make Money in Stocks, I believe it was. David Ryan, Marty Schwartz, James B. Rogers, Mark Weinstein, Brian Gelber, Tom Baldwin, Tony Salaba, and Dr. Van K. Tharp. So basically, I'm just going to go through the highlights that I basically underlined in this book as I was reading it. It took me about a month. Look how thick this sucker is, okay? I read cover to cover, by the way. And the book is a whopping 480 pages. So if you're a fast reader, you might be like me and finish it in a month. If not, it might take you a little bit. But let's just jump in. I kind of had stuck my bookmark here where I kind of wanted to start. And in the interview with Michael Marcus, and just basically I'm just reading what I've underlined because there was a reason for it. And as I go back and reread what I underlined, I'm like, ooh, yeah, great tip. So Jack asked him, did you keep track of like which trades broke even and which didn't? And he said, just a simple thing here. I knew that the big money was going to be made on the trades that met my criteria. I think that's just like such a simple yet overlooked thing. Like, right, if you're trading a specific setup, realize that if it's meeting all your criteria, that's the best chance for you to make money because you know your setup, you know your best chances when you get in, and you know the pattern of what to trade. Let's skip ahead here. He talks about being tipped off that you're near a top, like of a stock or the market. And he says, one of my rules was to get out when the volatility and the momentum became absolutely insane. So kind of like a know your tolerance for risk, I think is kind of what that's saying. It's like, yeah, if you like markets like that, which I personally do, then go for it. But if you are like, hey, this is like just too much, I don't know. For me, one of the things I know not to trade and I get out if I sense that it's happening is ranging markets. I'm not a range trader. I'm more of the scalp trader. And so if things are stuck in a range, I'm like, no, to me, the risk is higher to stay in that trade at that point. He says, by the time the markets got difficult again, I was a good trader. By then I had really learned my craft. And I think he was talking about his history of like, starting with losses, starting in a tougher to trade market, then having, the bull market that he went through. I guess this was kind of in the 70s. And then by the time another bearish kind of market, another tough one came along, he was ready. He was good. And I think right now, if you're trading in this, we're pretty much in the edge of the bear market because the NASDAQ is already officially a bear market. The S&P 500, should it close today, I believe, today being April 7th, that if it's in the correction territory and it stays down 20%, then we will officially also be in a bear market for the S&P. So to me, that's, both of those are bearish, then that's what we're in, right? I think if you can trade during these times and come out on top, like, you'll be better prepared as a trader, because it's probably going to happen, throughout your like trading career, that you're going to go through several bear markets, and each time you're just going to get better at trading, because this is really where you can hone your craft. That's for sure. Okay. He also says, I would always bet less than 5% of your money on any one idea. So instead of being all in on something because you're like, yeah, I know this is going up, I know it, put all in. No. He's saying with your capital, always bet less than 5% of your money on one idea. So, spreading out the risk, kind of says to me he's a little bit of a swing trader. I'm kind of the same way, where I don't want to be in like a whole bunch of swing trades. It's like, no, put your focus on a few, but also realize that you shouldn't, like whatever you have capital wise to invest in those, you shouldn't put more than 5% of your overall count, right? This is a good tip too. When in doubt, get out and get a good night's sleep. I've done that lots of times, and the next day everything was clear. So don't feel like you have to be always in a trade, always taking a trade, every day trading, 5 days a week. I've started to learn this myself, that I do better overall if I trade 4 days a week. It just kind of gives me that extra relaxed day, where if I'm feeling off one of those 5 days, maybe I just want to sleep in. I'm on the Pacific coast, and getting up consistently every day, like 4:15 a.m. in order to trade to the open, at 6:30 a.m. It's early, right? It's freaking early. And there's some days where, I just want to sleep an extra hour. But I know if I do that, it's going to mess me up that day. Like, I'm going to come to the market less prepared. And so I kind of give myself the grace sometimes to just say, okay, if there's a specific day of the week, or sometimes in the past, Fridays have just been an obvious day for me to step away, because I've had more red days on Fridays than any other day of the week, it seems like. So that's just one of the days. But this past Friday was great. So maybe that's changing for me. So next up, how important is gut feel in trading? Being a successful trader takes courage. The courage to try, the courage to fail, the courage to succeed, and the courage to keep on going when the going gets tough. And, that's a really important thing to talk about, because it's so easy, especially when you're new, when you're starting trading and you're like, okay, maybe you have a few wins, but then you take a few losses. Maybe you have a down month, some down weeks, whatever. And it's really easy to get discouraged. But, the idea that, hey, somebody even at the top still has to work on this, to be courageous, to keep coming back, to keep trying. A lot of people just can't. They just mentally can't accept, number one, that they were wrong, ego. Number two, that they lost money. Number three, they can't handle the mental fortitude that it requires to continuously come back and try again when you've, been quote unquote beaten down numerous times. And it really, to me, it's all in how you frame it. Like, did you really get beaten down? Did you just get stopped out a few times? You know what I mean? Like changing your words, changing the way you think, I think is really the key behind this courage idea, being able to come back and keep doing it. So you got to change how you think about it. So it's good stuff. Let's move to okay, so Bruce Kovner is his name. Okay. This is kind of going off of what the Marcus guy said. He's talking about getting out of a position. And he says, to this day, when something happens to disturb my emotional equilibrium and my sense of what the world is like, I close out all positions related to that event. So if you're, and I've heard other traders talk about this, if you have trouble sleeping at night, like let's say you have a swing trade open and it's affecting your sleep, like you probably should get out. Basically, don't let any one trade rob you of your peace. And I think the same could be said even in short day trades. You know, if you get in and you saw your setup, you felt like it was correct, but something else is coming up inside of you, whether it's justified or not, whether it's on the chart or not, realize that whatever emotional equilibrium, he calls it, is off, that's going to affect that trade. And you could be right and you can make a profit. You could be wrong, you know, take a loss, but just being aware of something is off might be a reason just to get out. Okay. What else we got here? I'm trying to find all my underlines. He's talking about like getting into a trade. I know where I'm getting out before I get in. I always, skipping ahead a little bit, I always place my stop beyond some technical barrier. This is something I know for me, I'm going to have to get better at. Right now, I'm just trying to minimize risk. So I'm placing stops that make sense for me and where my risk tolerance is. But yeah, I totally get that. Place your stop below a technical level. Because if you place it right at a technical level, like chances are, yeah, it could come right back down and hit your stop. Oh, and then he says, you know, do you worry? He's asking the question, like, do you run into the problem that a lot of people may be using the same stop point and the market may be drawn to that stop level? And he says, I never think about that, because the point about a technical barrier is that the market shouldn't go there if you're right. So if you got it just below, if you're correct in like going long on this position, then you shouldn't be an issue to have your stop at or just below that barrier. Okay, moving ahead. Principal characteristic of a bear market is very sharp down movements followed by quick retracements. I have seen this in action so many times lately. Like, this is exactly what a bear market is. You know, previously, before I was a day trader and, thought of a bear market, I was just thought everything's just going down all day, every day, right? And it's not the case. If you traded this morning, maybe you noticed this too, that there was a lot of sell-off over the weekend. There was a lot of sell-off pre-market. And then just after the open, all of a sudden the buy the dippers were flooding in. There was huge green candles on some big name stocks, huge volume. I saw the biggest volume candle I think I've ever seen on Palantir this morning. And it was so high. I don't know if I can go all the way back to, let's see if I can show you. Let's go to the 4 hour here. Okay, so this is my 4 hour chart, but there was just this enormous volume. Okay, you can kind of see it. This is a 1 hour chart right now, but there's a candle. A volume spike right there. That's about 2.5 times bigger than the other, buy and sell volume. Let's see, it's going to be about 15 minutes. Yeah, see, like when I'm looking at my 5-minute chart this morning, this volume spike was so high, it was into the actual candlesticks. And I was like, whoa, there's some serious buyers stepping in. So when he's talking about these retracements, yeah, because people see these stocks plummeting and they're like, oh, now it's on sale, all right? And whether that's really a good time to buy or not is irrelevant. It's like, what is the market doing? You got to follow that. So he says, too, in a bear market, you have to use sharp counter-trend rallies to enter positions. I've successfully done this a few times lately, since we have kind of entered this bear market correction phase, whatever. And it's almost become easier sometimes to wait for buying to get exhausted and to short it, or you see that like maybe like a double bottom or something, and you're like, the signs are all there, it's starting to turn around, but that there's going to be a counter trend of like, hey, it's oversold and now we're turning back up. And that's actually how I traded this morning with Palantir. It was oversold and I could see it starting to turn around, and it was a successful trade. So yeah, this just good stuff to know, like, for what we're in right now. Let's go. Oh, this was a good quote. Like, I just was like, ooh, I can't wait for this to happen. He's talking about, or Jack is asking him kind of like, being intuitive with the market and stuff. And he says, when you are really involved, the screen almost reaches out and grabs you. And I kind of felt that myself a little bit this morning, where I was so focused on the trade, the process, my strategy. I was not looking at the P&L at all. And this, the stuff on the chart was like clear and obvious, like go long here, go short here, watch for this. And I'm almost, he talks about the screen reaching out and grabbing you, a little bit of that, but I also felt like there was like intuitive voices in my head, like wait for it, pull back, micro pull back, then get in. And that was one of my trades on, I did TSLQ, the bearish ETF for Tesla today. And I'm like, ooh, I waited for it, I listened, and I got in at a really great entry price for it to then shoot up, and I got out within like 15 seconds for my scalp. It was awesome. Okay, so what else? What I like too, that in the book, Jack kind of summarizes after the interview, just some of the key takeaways that he got from the interview. And he said just about Kovner, I place my stop at a point that is too far away or too difficult to reach easily. In this manner, Kovner maximizes the chances that he will not be stopped out of a trade. The philosophy behind this approach is that it's better to allocate the predetermined maximum dollar risk in a trade to a smaller number of contracts while using a wider stop. So buy less in terms of position size, but use a wider stop. So that way your risk, can pretty much stay the same, but you've got that wider stop, which gives you the chance, right, of getting on that winning side of the trade. Let's go to the next one. Okay. So Richard Dennis, I remember reading this, and I have since followed it pretty much every time. He's talking about closes on Fridays. He says, at a minimum, it is important not to have a short position with a loss on Friday if the market closes at a high, or a long position if it closes at a low. And I think this, whatever you consider, if you're swing trading, for example, holding over the weekend, be careful with that, because Mondays and Fridays are usually the most uncertain days. And yeah, basically if you're short and the market's way up on Friday, get out. If you're long and it's closing low, get out. So, okay. This one, he's talking about recouping losses. He said, I also learned that a certain amount of loss will affect your judgment. So you have to put some time between that loss and the next trade. I struggle with this sometimes. It's, when I was trading full position sizes, I would have that in the back of my mind, of course, next trade. I'm like, well, last time I lost money and this time I got to be right, trying to make up for it and all that sort of thing. You got to put the time between them instead of just jumping right back in. Because I think in some cases I would jump back in just to prove to myself, I'm not afraid of the market. I'm not afraid of trading, and that might not always be the best thing. If you're taking, like he says, if it's kind of something that affected your judgment, you took a loss and you're, beating yourself up over or whatever, you got to step away. It's best to stop trading that day for sure, and maybe even take a day off after that. That's really helped me get over some losing streaks where 1 to 2, 3 days in a row red. It's like, okay, my rule is, 3 red days in a row. That's it. I'm done for the week. And I have broken that rule, but I find it so much better to stop, because when you're away from the charts, you're away from the trading, you can be in a better place, right? Okay, so, and this was just a good point. What you can't afford to do is throw away your capital on suboptimal trades. How often do we find ourselves trading just for the sake of trading? Like, oh, I got to take something. I got to get in. I got to play. I got to be in the action. Is it suboptimal? I'm not sure which interview it was. I think it was somewhere in this book. Somebody asked or said to ask yourself the question, would I have gotten into this trade after the fact? or do I want to be in this trade even before the fact? Like, just question it sometimes. Okay, so Jack asked him, what do you do in a situation where your feelings as a trader tell you to do one thing and your systems point in the other direction? Great question. If they are absolutely opposed, you do nothing until you resolve the conflict. I think that's a really good statement, because I know for me, it's a lot harder to make decisions and to really have that confidence in what you're doing and taking action if one side of you is like, yeah, the chart says it, and then the other part of you, gut feeling, feels like, I just don't know. I felt this even today, where I'm looking at the chart and I was like, okay, now's the time to get in. All the signals are there, my indicators, and, I'm watching these things and all that sort of. And I'm so glad I waited, because the gut feeling was like, and I would have definitely gotten stopped out trying to short Tesla at that time. I'm glad I listened. I'm glad I went with the gut. Even though the charts, were saying something, I just held back from doing anything, because I'm like, no, it's not in alignment. It's not lining up. So it's exactly what he's saying. You got to resolve the conflict. And by waiting, I saw that I would have gotten stopped out. It went up for a quick spike, only to then start to go lower, and that's where I got it. But it was like, yeah, I don't know why I feel this way, but I'm just gonna sit back. Okay, expect the unexpected in this business. Yep, good one. Okay, as a scalp trader, as a quick day trader here, I really liked that he asked what tells you to get out of a position. He says, even when you are around break even, but a significant amount of time has passed, you're probably wrong there too. So I think this comes down to what kind of trader you are. If you're totally comfortable holding trades 30 minutes, hour, a couple hours, intraday, then maybe this doesn't apply as much. But if you're like my style and you want to get in, get green, get out, as Ross Cameron says, then you might consider like, okay, it's taking too long to get to where I was thinking it was going to go. So you have to just accept, yeah, maybe you're wrong. This is just the wrong entry, the wrong time. Maybe you're not wrong overall, but if that's how you trade, it's the wrong time to be in it, right? Okay. So they're talking about losing streaks. How do you handle losing streak? He says, cut back. If it is really bad, stop and get out. And then he's asked, do you sometimes need to get away from the markets for a few days? Generally, it just takes a day or two, but you do need to stop for a period of time. This is what I try to do. At least have a pause. It could be for just one day. I like that. You don't just like quit. You're not running away. Just give yourself that space. Okay. This was a good one. He asked about, are you able to avoid the emotional trap? And what I really liked that Richard Dennis says is, if you feel too good when things are going well, you're like, yeah, I'm winning, I'm crushing it, and your emotions are high and your energy's high, then inevitably you will feel too bad when they're going poorly. So consider that on one end of the spectrum, you want to feel those great elated feelings, you're fist pumping, you're like, yeah, I did it, whatever. But realize that the intensity of that winning trading and the intensity of the losing trading are going to be on the same scale. So do you really want to feel horrible and sad and emotional and upset, and maybe you get pissed off when you lose? So kind of what he's talking about is that neutrality state of just, cool, I win, I lose, it doesn't matter, next trade, please. Like just being almost like stoic and just, hey, whatever comes my way. I'm starting to learn this because I feel like, maybe it's my heritage, my background. I'm a Sicilian, like high passionate, high energy, but when it comes to trading, I'm trying to learn to be more calm and at peace when I sit down to trade, have a clear head, have a clear mind. Great if I win one, you feel a little bit of like, woohoo, and then you just say, okay, what's next? If you lose, okay, what's next? You know, like of course, learn from every trade. And for me, I definitely feel like I learn more from a losing trade than a winning trade. There's just more lessons to be taught. But try to find that middle ground where you're not overly excited, like, yeah, and overly sad or angry if you lose, right? You just gotta kind of find that middle state. Doesn't matter. Don't care that much, okay? So let's finish off Richard Dennis here. Okay, what is the most important advice you could give the novice trader? Trade small, because that's when you're as bad as you're ever going to be. Don't be misled by the day-to-day fluctuations in your equity. Focus on whether what you're doing is right, not on the random nature of any single trade's outcome. Does this sound like Mark Douglas or what? Does this sound like exactly what I've been doing on this channel with my 20 trades experiments of working on trades in a series versus focusing individually on each trade and trying to, like, you know, fix something? It's like, no, you focus on the overallness of it, not the individual trades, and that's how you get better. Focus on whether what you're doing is right. So I've heard it said 20 trades, Mark Douglas. I've heard it said 100 trades, whatever it might be. That gives you kind of a series that can show your patterns, your habits, what you're doing right, what you're doing wrong. And don't just like focus on, oh man, that one trade today, and then beat yourself up. Or focus on the one winning trade and be like, I'm amazing, and then, you know, messes you up, overconfident. So guys, I'm gonna stop the video here. I'm gonna do another part 2 of this book, because I mean, look how massive this is. I'm only into my highlights here from, I got to page 112. It's like 400 pages here. So actually almost 500. I'm gonna keep, I'll make another part 2. I might even have to make a part 3 on this, because this is a lot. I underlined a lot of stuff in here, okay? But I don't want to, overwhelm y'all. But if you like the video, feel free to comment down below part 2, and feel free to check out my day trading resources. I have a link to the book in that. You can access it for free. Just got to put your email in there, and I'll see you guys on the next one. Take care.